Something extremely rare just happened in markets that has everybody talking coming into this week's inflation and Fed meeting data. But the lines are also being drawn for 2024, with big bulls such as Fundstrat's Tom Lee and Oppenheimer coming in above 5,000. Oppenheimer is claiming 5,200 by the end of the year, while bears double down on corporate earnings being the biggest focus of 24. Which side do you have? Today we discuss both A and B scenarios when the Fed eventually does place a rate cut. We also need to talk about equal weight markets because we're seeing continuous rotation, which have been focusing on the channel for a while. But in the midst of all of this, a sign of a market cracking. Bitcoin with a big sell-off. The Mag 7 didn't perform, but semis did. What does that tell us about the markets moving forward? Well, welcome back, everybody, to The Daily Show, where we talk about everything to do with stocks, commodities, and cryptos together. My name's Tom. We've been running this show for over 3+ years. And if you like anything to do with markets, remember to subscribe and smash that like button. It really does help us out. Let's talk about the last 24 hours, though. And if you are looking at this and saying, what's unusual? Yeah, it would be the Mag 7 was actually all negative for the session. Yes, Mag 7 was down, the strongest market of the year, yet semiconductors were up across the board. Not led by Nvidia this time. AMD really the focus of the last couple of weeks, but AVGO, Broadcom doing incredibly well. You'll also notice there were some other good sectors that did happen, and there was a bunch of rotation occurring, which we'll talk about later on in today's show as we cover off everything. But let's talk seasonality for a minute. This is what tends to happen with December. So if you're a bull in the markets, you're kind of celebrating the potential here for the end of the year, because really this is meant to be more of a coiling market. Or in years such as this, technically it could be a downward area. We're still in the week of volatility though. So remember, coming out of the 15th is usually where you start to see more bullish intentions of the market. What about some bull cases though? What are some of the things that say there could be more to run in the markets, even though it seems ridiculous? Well, New York Stock Exchange 52-week high-low spread has just turned positive, and it's given another buy signal. Now, you'll notice that we've had really 1, 2, and 3 of these recently, and all of them have been pretty good. Now, you could argue that the sell signals haven't been fantastic because there is one false sell signal here, but overall, I'd say that's still not a bad strike. We also know that the stats are plentiful. We have many of these reads, and it's actually interesting to note that the first month is usually where we see that kind of weaker stat come through, followed by much more bullish stats over the next 6 and 12 months. An interesting fact, maybe worthwhile watching out. So we posted 2 things in our weekly newsletter that went out just before the Monday market open, and that's when we do post it. Links in the description if you're interested in finding out more about that. And one of them was this one, repeatability. So if we end up booking a 15% plus year for the S&P 500, it turns out the odds of another good year are actually pretty high. In fact, the odds of an over 10% year are 50%. The odds of over a 15% year are 32%. Now, that's pretty strong considering how good this year's already been. And you might think that's ridiculous, but that's just the fact. 71% of the time, we saw a bull market in the next year. Something to keep in mind, and of course, keep in the back of your pocket. Another one that we posted was this though, scenario A and scenario B. And this is a chart that we've had a few times on the channel, which shows you both the bull positive side and the bear positives or the bear negative side coming out of a Fed cut. Now, some of you are going to say hard landing. Some of you are going to say soft landing here. But you know, the interesting thing or the most horrific thing about all of this is we do actually tend to see a lot of chop in other historical markets coming into the Fed cut. So it's pretty sure, especially if the Fed this Wednesday, remember, the one thing is that we've never seen the Fed pause for over 5 times without never rate hiking again before a cut. So that would be a 100% track record so far with history. So if that happens, could we be going into a coiling market for quite some time with more of a rotation? Possibly Mag 7 comes down, other stocks go up, and we slowly melt through with ups and downs and all arounds. I think that is a definite possibility, but you really want to study this chart. If growth looks like it's coming through in 2024, this scenario, we'll call it scenario A, is more possible and probable. But if growth doesn't come and corporates, of course, start to really struggle, then scenario B is in. and you've got to watch out. Remember, on average, it takes 180 days for markets to actually go down and find their lows. And that usually is what a sign of recession is. And one of the signs of also impending recession would be the US 2-year versus 10-year, which we'll talk about later on. Let's discuss inflation because, of course, that's coming up. Now, the expectation is that inflation will continue to moderate. It might even just sit around here. So I don't probably expect a huge move off inflation, but who knows what Wall Street and the rest of the big wigs want to use as a form of volatility spiking. You can see here that inflation's been coming down. And of course, we also can see here that consumer price expectations have been pretty muted recently with relatively stable movements over the last kind of 4 to 5 months. Now, there are some sticky sides and of course there are some concerns, but overall it has been pretty disinflationary, which is something the market tends to like. In terms of expectations for this week's Wednesday Fed cut or Fed hike or Fed anything, it's pretty much going to be a nothing burger. Now, the big thing is going to be the Fed speech, where Jerome Powell will no doubt come out, and I'm sure he'll say all sorts of things to probably spook the market a little bit, and there won't even be anything new. Let's see. What do you think Jerome's going to say? Let us know in the comments down below. Let's get into some interesting charts now, though. Let's go the bull side still, then we'll go the bear side very, very soon because there are some negative things as well to talk about in markets. But one of these has to be, this really high call put ratio that we're seeing really spread everywhere through the internet. Everyone's been talking about how many calls there are on IWM. And the thing about that is that we've actually seen, a lot of calls, but really we had a ton of puts in there as well. Now, when we get these big reads similar to where we are right now, these huge spike ups, you might say, well, that's negative. Everything's looking pretty bad. But actually, it's pretty good. You can see actually most of the time, the track record for the Russell when we get similar reads like this is pretty positive. And there haven't been that many times that we've seen them, but they've been actually a good run. So again, it does speak into the seasonality factors that we've seen here for the Russell, that we've seen for the mid caps. I want to remind everybody though, that just to remember that the Russell is filled with kind of some trash companies. So of course, we've already been seeing really strong gains out of the Russell 1000 growth. We've already been seeing some really strong gains out of quality mid caps, and it is already happening. So you do need to be careful. Russell 2K has a lot of trash companies in it as well, which needs to be accounted for. Now, do we have plenty of opportunity coming into 2024? If you're a bull, the answer is quite simply yes. So many underperformers for 2023. Really, it was Mag 7, Mag 7, Mag 7 up until recently, up until maybe a month ago. And that's all that mattered. Really, it was just Mag 7. Then we saw that move up in course of gold. We've seen moves through the materials sector. We've seen moves into all sorts of different sectors. But you'll notice here in terms of laggards, there are many, 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 many still out there that are underperforming versus the S&P 500 for the year. So plenty of opportunity out there. A lot of people are speculating that everybody's all in on the bull side in terms of retail. We've already talked a few times about the biggest issue, which is that sentiment's super high in the sentiment reports, but we've seen retail also trying to short against that sentiment, going against the grain. Unfortunately, until retail actually stop doing that, it's going to be hard for markets to really move down, and it's going to happen when you least expect it. Now, according to Robo put call ratios, we are not in the excessive kind of call buying periods, and we really haven't seen even necessarily a huge spike up yet. We will be looking for it though when it gets to these higher points. So of course, something we're watching is more calls to be opened and price action to come with that. For technical indicator members out there, 14-day RSI is certainly hit a peak. Goldman Sachs has just reported the 14 RSI overall in the markets. Now, this is pretty big, is above 70 extremes for the percentage of S&P 500 stocks. So this doesn't happen that often. You can see there are a few reads, and notoriously it can still have a bit of a rally in it before selling off, but it's certainly a time for caution generally in markets, and that's something we will be looking at. Another one for the bulls and the bears is going to be this Christmas season, and something we call the Grinch. So that's a 3 days into Christmas trade period, then 3 after. So 3 before, 3 after. Now, if we see a negative Grinch, that is basically a bad period of time around there, Wayne's done some great research here, and he's found out that actually we have usually a pretty good year the year after. Whereas if we have a negative Grinch, which is coming up, we have often double-digit losses in the next year. That's surprising how good it's been at picking those. And just to give you a bit of an idea here, to the contrary, if we have a strong Grinch, so that is a actual bullish period, 11 of the 12 S&P 500 double-digit loss years since 1950 followed the positive Grinch. That's a crazy stat when you think about it. Now, what about OPEX week? Well, the stats are in the bulls' favor in general. However, it starts to die off a little bit at the end of the week. I would say there's either going to be the CPI or, of course, we've got two other factors. We've got the FOMC meeting, most likely, or not the meeting, but the speech by Jerome that could move the markets. And then, of course, we have OPEX to discuss and where the options are for this week. But I'm sure it's going to be volatile, and the VIX is expected to probably spike into those events. What about biggest monthly gains followed by what happens next? Well, again, December is tracking to be up, down, and all around. Don't get too excited about how generally December would perform. Remember, we just saw a top 20 S&P 500 monthly gain. We're witnessing history all the time here in the markets, and a top 20 is a very strong run, which often ends up getting burnt in time. So we really only started doing a bit of sideways. Now we're kind of here with the US stock market. We've got some levels to be watching, and we'll talk about it later on. Let's also talk about when we get 20-day breadth thrusts. Do we tend to see positive years the next year? The answer is quite simply yes. If we end up getting a negative Grinch as well, this might be a stat that's worth saving because, of course, those stacked together with some other things could be a bullish year in terms of just the general expectation. Again, they're all stats, but when you start to bring together little bits of edges, it can be helpful. So the Mag 7 has been one of the single stock net exposure drop-offs recently, and we reported this on our X account. You can follow in the links in the description down below, and it showed us that basically we were seeing prime book exposure dropping off. It went from 20% down to 17.6%. Since we've seen these drop-offs, guess what? Mag 7 hasn't been the place to be, and small caps and mid caps, quality ones anyway, have performed much better. Let's go into treasuries and yields. Now, we just saw a massive, huge outflow supposedly in treasuries. We talked about the first outflow. Everyone was freaking out about this, and we actually thought that we would see a bit of a spike up in treasuries. We're now at a point where there may be some weakness, and we'll go through that later on. But yeah, a huge sell-off there in treasuries. I wouldn't be worried necessarily as a longer-term investor, but something to be on the lookout for. In Europe, it is cheap to buy put spreads as well. No wonder the DAX is flying and melting up. So again, Goldman Sachs coming out with some big reports here saying it's cheap to buy puts, guys. Everybody's cheap. But that doesn't mean the market's going to go down just today. Another thing with reports is that, of course, here's a great one which has what's going on with underperformance. And basically, China's been one of the worst markets of the last couple of years. Now, we just saw some downgrades. Moody's downgraded China. Now, they've done that 4 times, and I thought this was worthwhile bringing up because you'll see on the next chart why. And whenever they've downgraded it, the next year is actually followed by positive gains. I'll just read out some here. Plus 9.8, plus 41.8, plus 89.3, plus 19.8. Some pretty amazing stuff. We also just saw some large inflows into China, the biggest inflow in 11 weeks. So all of a sudden, somebody's decided, oh, hey, we might want to be looking into China, and you will see a dark pool transaction coming up, which is quite surprising on KWeb. Retail investors have become increasingly bullish. Yes, we know this. And of course, many people are looking at these survey reports and saying, look, it's got to go down. Unfortunately for everybody, yes, at the same time as everyone's claiming they're bullish, they're still trying to short it. And that is a bit of an issue. So I haven't updated these stats, but I will do so soon. I can tell you that the DAX is dropping a little bit here in terms of bearish bets that are going more into the bullish bets. And that's the type of thing that you want to see. So it's gone from like that kind of 90% down to around 82% at this stage. So these types of things are showing us that people are starting to join that kind of bandwagon with their leveraged positions. And it's taken a while, but that's where it's at. TD Ameritrade as well actually showed the same kind of thing in their recent survey. You can see here that we had basically positions shorted. However, the market was going up. So that's a big reason. There's still a squeeze that's been going on in the markets for now. CTA estimates are that they kind of overbought, which is basically something that you will be on the lookout for. Remember, these CTA things take a while to play out. So again, it's just a signal to show that if you get price action towards the bear side, it could be the real deal. And really at the moment, we've just seen the Mag 7 really show the weakest part. And that's been consistent now for about 2 or 3 weeks. Let's talk big dark pool activity now. Big one here coming in for the Chinese market. KWEB, huge dark pool, very interesting, of course, accumulation cycling here. And we've discussed this point or discussed these points a few times. So it's something that we are